delving into stocks, property, bonds, economics, and more. This is the Stock Market Mentor podcast. Taking an unconventional stance, we challenge the industry to help you protect your investments and empower you with the knowledge to become a savvy investor. We don't provide financial advice. Here's Steve Moriarty, Tom Hill, and Jacob Sr.
All right, welcome back to another episode of Total Money Management.
What?
It's probably a new one for you guys. Last week we were Stock Market Mentor. We're now Total Money Management. So
it's crazy what.
There you go. Huge rebrand.
Absolutely.
Huge rebrand. It's enormous.
Look, I'm here with Steve Moriarty and Jacob Sr. And what we're going to be discussing today is monetary policy and fiscal policy.
Ooh.
So it's probably not the most sexy subject that we have.
So interesting.
Jesus.
It is important.
There's nothing more to life than monetary policy or fiscal
I've
policy.
actually been thinking about it all year.
Look, the aim for this call today, right, is just to get you guys to understand the difference between monetary policy and fiscal policy, who controls them, and why there's going to be a change. So
Yes.
I'll hand over to you, Steve.
All right. Since I'm the oldest, and I remember when we actually had fiscal policy. Thanks, Tom. Basically, the idea is what we're saying, again, we bring it back to the four C's, right? The COVID, conflict, children, and climate. And what we're trying to do is say to people, the world is changing, and therefore you're going to have to invest differently to the last 30 or 40 years. Okay. Now, the next step is like, oh, why is that, boys? And the reason is because the last 30 to 40 years, the reliance has been on monetary policy, not fiscal policy, okay? And so just to give you some, as Tom said, not so sexy definitions, monetary policy is basically interest rates, right? And that is the domain of the Reserve Bank, right? So as everybody knows, the Reserve Bank's been raising interest rates. They talk about monetary policy, right? Fiscal policy is the government. So that's Albanese and Jim Chalmers, and their fiscal policy is about the budget, right? The federal budget is, so at the moment, the government, I think, has a surplus of about $25 billion, right? So that is the way that the government uses spending and taxation to control demand and unemployment and inflation, right? So you've got sort of two levers. You've got interest rates, and if you jack up interest rates, people will stop, generally, borrow less money. That will cool the economy down, and that will cool down inflation, right? That's what monetary policy is about, and that's what they're trying to do at the moment. Fiscal policy is saying we're going to have a national infrastructure program. We're going to spend $300 billion and it's going to create a bucket load of jobs. Look, prices will rise because instead of working as a barista, Tom goes out and works as a labourer and makes a lot more money. So the guy who owns the coffee shop says, oh, well, now I've got to pay $17 an hour, not $13, because I've got to get someone in, right? So that's the way they generally work together. The historical point is after the war, during the war, government spent lots of money, right? They built lots of bombs and they bombed lots of bridges and houses and blah, 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 right?
And then built them back again.
And then built them back again. That's what you do, right? So you bomb them and then you rebuild them. So the point being, though, after the war, the government had a really big debt. Now, they had to pay down the debt. And so as they reduced their debt level, the private sector borrowed more money, right? And so that went on for about 35 years, right? And then what happened was the government stopped using fiscal policy as a driver of employment and stuff, right? Because they sort of went, listen, guys, we rebuilt all the houses and we've built a lot of the bridges and the roads and all that sort of stuff. So then they swung over to monetary policy, which is generally about people like you and I, right?
Drop the price of money, allow them to, borrow to create businesses, buy properties, create jobs.
Exactly. So as the important part, I suppose, is monetary policy is about interest rates. And if interest rates fall, then investing becomes more attractive relative to the value of an asset, right? So I'll do this to start with because it's the sort of fundamental point what we're trying to get at. If you've got $1 million property, let's say you borrow $800,000, right, and you buy $1 million property, and you're generating rent of $100,000 a year, right? And you say, okay, well that's yielding me 10% on $1 million, right? And I'll ignore the loan in terms of the actual real value. The point being, if interest rates go from 2% to 4%, the rent may stay at $100,000, but your repayments have gone from, say, $40,000 a year to $60,000 a year, right? So now what you're seeing is going, well, hang on, before interest rates at 4%, I was making 60 grand. Now I'm only making 40. In order to make 60 or make the same percentage, the value of the property's got to fall, right? Unless you can increase the rent. So if you can't increase the rent, what I say is, well, Tom, I want to make 6%. And you say, oh, well, Steve, I bought it at $1 million and I'm making 6. And I say, yeah, but Tom, now I've got to pay more money to the bank to repay the loan. So I'm only going to give you 900,000, right? So that's where it's really critical to understand the difference, because as lots of property investors are finding out at the moment, the value of the repayments has gone up considerably, right? 30 or 40%. Now, the problem is, what that really means is the property value is actually going to fall, right? Because before I was saying, well, I'm getting 6% on the property, and then you go, well, no, actually, you're not getting 6, you're getting 3 now because your repayment's higher, right? And so that gets back to the point again with monetary policy, with when it's rising, when interest rates are rising, right? If you can get 5% in a term deposit like you can now, why would you buy a property if it's only yielding 3%, right? What you're doing is saying, yes, Steve, but the property price is going to rise. And it's like, yeah, but what if it doesn't?
Well, what about the argument that, you can get into $1 million property with $200,000, but if you've only got $200,000, then, that's all you've got in your term deposit.
Yeah,
obviously,
but
property's leveraged.
Yeah, exactly. That's the whole point, right? What you're doing is it's just leveraging an investment. You see, it's the same thing, Tom, if I said, okay, Tom, we'll borrow 800,000 and put it in the stock market, right? Put your 200. So don't buy a property for $1 million, buy stocks for $1 million, buy the Australian index. You still get quote negative gearing, right? Because you're paying interest on the 800,000. You can still write that off on your tax like you can with rental income. It's exactly the same.
Oh, there's the big red flag of risk, though, isn't there?
That's the whole point, right? The whole point is you might, and I can tell you, most people would go, oh, bullshit, I'm not borrowing 800 to put in the stock market because it's really risky. And it's like, well, no, it's not. The stock market at the moment's paying about 4.5 as a dividend, right? A Sydney property's yielding about 2 to 3. Well, okay. Well, why do you want to buy a Sydney property? Yes, Steve, but the value's going to go up. And it's like, okay, but it's as highest it's ever been, right? We've had this 20-year bull market in property, and I'm not knocking property. All I'm saying is when you look at the valuation and you look at the risk, it's really, really tenuous, right? But to my point in terms of monetary policy, that's the way that we've operated for the last 30 years. Oh, Steve, everybody who's bought property, mate, it's just gone up.
So why is it not working now?
Because the world has changed, right? And this is what we're talking about, right? Everything cycles, right? And so if you look at monetary policy, let me give you an example, right? When things, quote unquote, changed, in 1980, interest rates were 18%, right? That's why boomers like me continue to go, oh, in my day it was 18%,
Yeah, these are
right?
still cheap.
I mean,
Well,
cost 50 cents to buy a house as well.
Well, it was, but there were a whole other raft of reasons. But my point being, as interest rates have been falling for 40 years, what that means is the value of assets have been rising, right? That's why boomers have got all the money because they bought a house in 1980 for, as you hear, 50 grand. Now they're selling them for 2 million, right? And young people like yourselves are going, WTF, right? That's unbelievable. But what I'm saying is when we hit zero interest rates at COVID, there was nowhere left to go, right? So what I'm saying is now, if you look at it, there's an enormous amount of private debt, right, out there. Everybody's got mortgages, or they've got, 2 investment properties, or they've got margin loans on stocks, or, right, all this sort of stuff, right?
You can't just turn that off.
Well,
It's going to be there. So you need to increase fiscal spending, create more jobs,
Right.
build more bridges.
Because if I come to you and you say, Steve, I've got 2 investment properties, and I go, Jacob, interest rates are at 2%. You go, Steve, I cannot possibly borrow any more, right? What do I do then? Well, I can't do anything, right? So what I'm saying is when the world changes from the monetary policy at zero, how do you get an economy to grow if nobody in the private sector is going to borrow like they used to? There's only one entity left that can borrow, quote unquote, or spend a lot of money.
The question I kind of rattles around in my brain is, we start increasing or move to fiscal policy, we create more jobs, we build more things, blah, blah, blah. But the employment market's the lowest it's ever been. We're at a 3% unemployment rate.
Yeah,
or
but
3.2 or something like that. So we create more jobs for who?
yes, but, and here's why
Migration?
here's why employment is no longer valid in my mind, right? Because everybody's an Uber driver, right? So what I'm saying is in here I go again, in my day, right? In my day, unemployment was high because there wasn't a flexible labour market, right? So you didn't get, in my day, you didn't go, oh, well, I'll just be an Uber driver, right? Or, oh, I'm just going to get on Airtasker and, freelance, right? There's none of that in my day. Now, the problem we've got is huge underemployment, right? So, the reality is you can't go into Centrelink today and go, oh, I'm unemployed, I want benefits. They go, no, I can go and get a job as an Uber driver or a pizza driver or, blah, blah, blah. So what I'm saying is you may find, and this is what I think you'll find, people are struggling because the wages are awful, right?
At that level.
Yeah. So we've got a whole raft of people who are the working poor, right? And that's
a good point.
That's a result of the way that the system's been operated.
So we can tick a box to say unemployment rate's at 3%, but the people that are employed at that level are not earning anything.
Exactly.
So they basically may as well be
well, they're not unemployed.
The quality of life box.
Well, and the technical definition of unemployment is if you work 1 hour a week.
Yeah.
Seriously? I mean, it's no good saying, but it's a valid point you point out, right? Because what you're saying is, well, hang on, Steve, all these people have got jobs. And it's like, mate, they're all poor. They're all poor and incomes are failing. So it's no point. It's again, if you look at the property market, it's equivalent to saying, oh, well, there's a boom in prices. And it's like, yeah, I know, because everybody's borrowing bucket loads of money. Once that stops, that's when the problems start, right? And the thing is, that's all driven by monetary policy, right? Why have we got less borrowing going on at 7% than we had at 2%? Simple, because at 7%, if I said to you, well, your property is going to yield 1% and probably negative over inflation, you go, well, I'm not bloody borrowing at 7%, right?
Yeah.
But banks are still putting out profits, though. That's the thing. People are still trying to borrow.
Yeah. But that's what I mean. That's the part of that's where you get to the bubbly end where investors, and I mean serious investors, don't look at it and go, yeah, I'll borrow at 7 and I reckon I can get a yield of 10 on that property. That's bullshit. They're yielding 2 or 3. What they're counting on is the capital gain.
Yeah.
Right? And most people look at it and say, yeah, property will keep going up. Look at Australian history. And as I say, it's the same with stocks, right? I saw this in 1998, 99, right? It was the same thing. People were saying, in 1929, right?
You're still around.
Yeah. I wasn't around then, but rumour. But Professor, I think it was Irving Fisher, said stocks have reached a permanently high plateau, right? Then they got the Great Depression, right? Now, what happened in the 20s to drive the stock market higher? They had a boom. They had a lending boom, right? They had a debt boom. So everyone went out and bought white goods and blah, blah, blah. Stock market rises. They get to the point where everyone's got a washing machine or a property, and it turns down, right? Because as the markets rise, the idea of monetary policy, which is what they're doing now, is saying, look, what we're going to do is we're going to cool the economy down because prices are rising. Okay, how do we cool it down? Well, with monetary policy, you go, well, we'll raise interest rates, right? This is what Michelle Bullock is doing and what Phil Lowe is doing, right? Oh, that coffee's bloody $5. Oh, well, I'm not buying 2 coffees a day. I'll only buy 1. Prices generally should start to decline.
Yeah.
Right? Now, think about this. If you've got bucket loads of debt and you start to cut back spending, you times that by 15 million Australian families. So suddenly the economy starts to fall, right? Now, I come along and I go, Jacob, hey, dude, borrow some more money. You go, mate, I'm struggling to pay the mortgage as it is. Interest rates have gone up, so my $2,000 repayment a month is now $4,000, right? Now I've got 500 less, okay? So long story, you get to, times that by 15 million or whatever, and what you get to is a point where you say, there's only one way they can grow the economy, and that's to go to fiscal policy.
Yeah.
Right? So it makes it...
It's a hard one, right? Because, look, I know everyone I speak to is feeling it. Everything's gone up a lot.
Exactly.
Right? That's the thing. But I feel like there's such a divide now. Like, obviously, this asset boom has minted a lot of people with a lot of money.
Absolutely.
So there's a lot of people that this isn't affecting them.
Well,
at all.
Yeah, and it's generally, and I mean this too, generally the older baby boomers, right, like me, because we've paid off the property, and what we're doing now, right, I'm looking at it now going, fucking fantastic, I can get 5% for doing bugger all. Now, if you've got $1 million or $2 million and you don't live an outrageous lifestyle, you go, great, I'll just live off the interest. Why do I have to take a risk in buying a property or buying more stocks? I'll just sit there in 5. Right, and it'll probably go to 6. This is great, right? Whereas young people, as you say, Tom, like yourselves, are going, man, I can't even get, I can't buy a bedroom, let alone buy an apartment, let alone buy a property, right? That's the point. We've reached the point where there's probably very few, or it's a shrinking amount of borrowers, and this is what happens in every sort of bubble. You run out of people to eventually buy whatever it is, art, vintage car, stocks, property, that's what happens. And when you reach that point, cutting interest rates doesn't matter, right? Because people are saying, mate, I'm paying down the debt I've got.
Yeah, I've already got heaps of debt.
Exactly. Now, there'll be, like you say, Tom, 10% of the population that go, great, interest rates are cheap and I'll buy more property, but generally that won't cover for the 90% of people who are,
just getting day to day.
Just getting by day to day.
So what should we expect to see over the next 12, 24 months moving to fiscal policy?
I think Steve's telling us to invest in a term deposit.
Well, but
you've got to have cash to put in though.
Well, that's true. But you can borrow, like. But it's sort of, but tongue in cheek, it's true, right? Because what I'm saying is that's the way things change, and what we're saying is monetary policy, that era from 18% to 0 is over, right? Now we're on the long cycle to go the way back up.
So you think they're going to keep climbing? Because I honestly probably should have come with a bit more research, but recently I heard that, the general consensus is that we'll probably see one more rise.
I know, but they said that when interest rates were about... Listen, mate, 24 months ago, 2 years ago, you listened to all those economists, right? They were all, and I'm serious, they were all full of shit, right? They all said, oh, no, interest rates won't raise before 2024, right? Even the bloody Reserve Bank governor said it. What happens? Interest rates go from 0 to fucking 4.5%, right? But what did people do? They all rushed out and bought bloody property, right? And now their $3,000 a month has gone to 5 or 4.5, and they're all struggling, right? And that's why I'm saying that, you know, these people who think they can predict the future are full of shit. Look at the economists. Their track record is terrible. You know, we've talked about this in a previous podcast. But my point being, if you take the big macro cycle, you look at it and say, well, hang on, interest rates went from nothing to 18% from 45, somewhere around there, right after the war. Interest rates went from 2 to 18. Then from 1980, they went from 18 to 2020, they went to 0, right? This is what I mean. These economists are saying, oh, they'll cut rates again. They might do, but they mightn't. If people think they're going back to 2%, they're dreaming, right? And they're dreaming because the world has changed. When, you know, the deglobalization means we're going to be paying more for stuff because the Americans are moving out of the relationship with China. And so that means we need more investment here or in America, and that means it's going to cost more. The demographics, right, what we're saying, there's less children, and so wages are starting to rise. Now, it's not going to be a smooth line straight up, but it will rise further and further, right? Climate change. How the hell are we going to pay for climate change? You sure as hell's not going to put it in the market price because it'll be too expensive, right? Governments will have to bear some of that burden. And that's why I'm saying, if you look at monetary policy, that's basically about you and I borrowing money, right? Fiscal policy is about the government borrowing or spending money, right? If you look at the 4 Cs, conflict, climate, children, and whatever that other one is, none of them are solvable by saying, yes, none of them are solvable by saying, oh, we'll just adjust interest rates. I mean, how do you solve COVID by adjusting interest rates? Mm-hmm. How do you solve climate change by adjusting interest rates? They've been falling for 40 years and we've got emissions going up. So you can't cut interest rates to solve climate change, right? It's the same with children. How do you solve a demographic problem with manipulation of the interest rates? You can't do it, right? That's why governments in other countries are offering incentives, right? Because you've got to see that the monetary policy, and we're going to talk about this in the next session too, why it doesn't work, right? Because at some point you have to say, well, you know, Steve, you can cut interest rates to 0. You know, I think it was a couple of weeks ago, we were talking about children, right? Well, why would you have a lot of kids? Oh, but Jacob, interest rates are at 0.
Yeah.
But if I said to you,
I think to your point, it works in an environment or an economy where you've got a square peg with monetary policy and a square hole fitted in.
Yes,
Whereas at the minute, we've got a square peg and it's a round hole and it doesn't fit.
Exactly.
So you need to change to adapt to it. And
exactly.
What you're saying is there's obviously macro cycles, everything cycles. The next 20 to 40 years, however long it might be, we're going to start to see a slow and grinding change.
Of higher rates.
Where we're going to initially try and use monetary policy, but most likely fail, and then slowly move to a fiscal policy to fit the new normal.
Yes, exactly. But and that's what we've been saying. We're in a transition period where, as I said, in the 70s, the Keynesian economics or the dominant theory was saying, I will just do this because that was the dominant theory, right? And what I'm saying now is the idea of using monetary policy, of using the private sector is no longer working, right? But what we're doing is we're still trying to say, yeah, but they'll cut interest rates. And it's going, okay, that's fine. But what if nobody borrows, right? And what we've seen and what they know from reducing interest rates too low is you get asset bubbles, right? That's why there's been bloody bubbles all around the world, predominantly in property, right? Because it's cheap to borrow.
Nice returns though in a bubble.
Absolutely, but they stop.
So if we bring this back to investing, right?
Yep.
So how do you think this is going to influence, how we invest, how you invest your money? Obviously, you've still found a way to make really steady returns. Is it your view that we're going to have to be a bit more selective about how we invest? The fundamentals will probably kick in a bit more.
Yep.
Obviously, my experience, in the last 10 years or so, I've shown an interest. You could have bought just about anything.
Absolutely.
Unless you got pretty unlucky and bought an absolute awful mining stock.
Yeah. Penny mining stocks, anyone, Jacob?
Some of them, as we know. But yeah.
But and that's the whole point, right? The point is, well, what do I do from here? And what you're saying, Tom, is exactly right. You could have bought any piece of garbage for the last 10 years and you've done well, right? The American stock market has gone up compounded about 14%, right? So that's doubling your money every 5 years. So in 10 years, you go from 100 grand to 200, 200 to 400. Steve, what's the problem, right? I bought it, you buy a property in Sydney, you buy it for $1 million, Steve, it's worth 1.7. Dude, where's the problem, right? But this is why I'm saying you've got to recognise that broader macro changes. And if you understand that, you realise that the 1.7 property is not going to go to 3.4 in 10 years, right? Now, let me give you some simple logic. Wages are not going to double in 10 years to sufficiently keep the ratios with those property values, right? And it's what you see in every bubble. It's the same for stocks, right? The values get batshit crazy to the point where someone goes, this is not logical, right? Now, at the moment in stocks, it's the big seven, right? Apple, Google, those sorts of things. PE ratios of 60, 70 and 80, it never lasts, right? So back to your question, Tom, the next 10, 20 years is going to be different because we're in a different scenario for the last 10 or 20. And so what we're going to do is we're going to have a lot more government control of the economy because the people who have got high debt levels can't just go, I'll wave a magic wand and I'll be debt free, right? And this is why I say you're going to have to be a lot more tactical, which means a little bit more short term in your investments. And it's going to be generally probably make more money in really boring stuff, right? Oil, infrastructure, and property where it's generating a good return. But at the moment, the American stock market and the Australian property market are really overvalued.
So the days of being able to buy anything and get rich are
absolutely.
For now, they're over.
Yeah.
Coming to an end. I think, to your point as well, finding something that pays a consistent dividend, it's reliable, it's not going to go anywhere.
Those ideas, like you're saying, Tom, those ideas are going, you just buy property and it doubles. It's like, sorry, that was the last 10 years. Even the last 20 years, it ain't going to be the next. And people will say, oh, yeah, immigration, blah, blah, blah. All of that's changing. Look at, just the week we're recording this, there's immigration problems in Ireland, right, in Europe. You've got Israel-Palestine war, you've got Russia-Ukraine war. So you've got all these burning issues. In Australia, they're now starting to say there are simply too much immigration, right, for the property market, for the labour market. We know they've been holding down wages, all of that sort of stuff. That's not, we are not going to be letting 500,000 people in here every year for the next 10 years and going, yeah, it's all sweet.
Yeah. All right, well, let's start to wrap it up. Hey, otherwise we're going all day. Look, I think a couple of things to summarise. I think be smarter with your investments as well. Now we're obviously moving into a different world, or we're moving from monetary to what we're predicting a fiscal policy, which is going to increase the amount of government spending. So, like I just said before, finding something to invest in which is a little bit more reliable and pays a good dividend would paying dividends, I guess.
Yeah, it would go a long way.
Anything you guys want to wrap up with?
No, I'm good. Probably just the last mention of inflation, because generally inflation will be a lot higher than most people have experienced over the last 20 or 30 years because, again, we've bought cheap stuff from China, all of that sort of stuff. So inflation will be higher. And if you're, and this is quite valid, people can say to me, well, Steve, yeah, mate, I get 5% in a term deposit and inflation's at 5.5%, so I'm actually losing money, right? And that's the new equation, right? You can't go, oh yeah, inflation's at 1, who gives a shit? I'm getting 5, hey, that's a net 4. Those days are over, right? Because when inflation's at 5, you've got to get 8 or 9% to say, well, I'm not making 9, I'm actually making 4, right? And Buffett talks a lot about that inflation, right? Because it eats away at your returns.
Yeah, we could probably make a whole other podcast on that as well. But like, guys, if you're interested and you want to know more, head to the website totalmoneymanagement.com.au. We write about these things weekly, monthly, and you can get up to speed. So alternatively, you can go to the website again and find our email and ask us a question. But for now, we'll see you next time.
Thanks.
Cheers, folks.
That's it for another episode of Stock Market Mentor. We hope you have enjoyed the show, and if you have any questions about the episode or want to discuss how we can help you become a better investor, please feel free to contact us at support@stockmarketmentor.com.au. We'll see you next time.